Something is happening right now in the precious metals market that most investors are completely ignoring. And the ones who figure it out first, the ones watching this video right now, are going to be in a very different financial position by the end of 2026. Here's the question everyone is asking: silver or gold? Which one do you buy? Which one actually makes you money this year? And what most people don't realize is that the answer is not as simple as picking a side, because there is a hidden dynamic at play right now. A tension building between these two metals that has only happened a handful of times in the last century. And every single time it happened before, one of these metals absolutely exploded in price. We're going to show you exactly what that is, why it matters, and what the data says is coming next. If this is your first time here, welcome to Gold and Silver Intelligence. We dig into the data, the history, and the institutional moves that most financial channels never talk about. Hit that like button right now. It helps more people find this kind of analysis, and we are going to need every one of you paying attention for what comes next. Let's start with something that will immediately reframe how you think about both of these metals. Most people treat gold and silver like they are the same investment. They are not. Gold is a monetary metal. Central banks hold it. Governments stockpile it. Billionaires park wealth in it during uncertainty. Gold moves slowly, deliberately, and it responds to one thing above everything else: the level of trust in the global financial system. When that trust breaks down, gold goes up. It is almost mechanical at this point. Silver is a completely different animal, and here is what most people miss. Silver is both a monetary metal and an industrial metal at the same time. That dual nature is exactly why silver can outperform gold so dramatically during certain periods, and it is also why silver can lag behind when industrial demand weakens. But right now, in 2026, something unusual is happening on both sides of that equation simultaneously. And that is what makes this moment so critical. Here is where things get interesting. The gold to silver ratio. If you have never heard of this number, you need to write it down right now. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, over hundreds of years, that ratio has averaged somewhere between 40 and 60. When it goes above 80, it has historically meant one of two things: either gold is overpriced or silver is extremely undervalued. And right now, as we are recording this, that ratio is sitting at historically elevated levels. Throughout history, every time this ratio has stretched this wide, silver did not just catch up to gold, silver outran it. In 2011, when the ratio collapsed from around 80 down to 30, silver ran from under $10 an ounce to nearly $50. In the 2020 pandemic recovery, silver exploded over 100% in just a few months. The ratio was stretched both times, and it is stretched again right now. But here's the detail most people miss. A high ratio does not mean silver automatically goes up tomorrow. It means the setup is in place. What actually triggers the move is a catalyst, and in 2026 there are not one, there are several stacking up at the same time. Let's walk through each one, because the combination of these catalysts is unlike anything we have seen in years. The first catalyst is industrial demand, and this one is reshaping the silver market in a way that most casual investors have no idea about. Silver is not just jewelry and coins. Silver is inside solar panels, electric vehicles, medical equipment, semiconductors, and advanced electronics of all kinds. And the amount of silver going into these applications is accelerating, not slowing down. The global solar industry alone is now consuming a staggering amount of silver every single year. Each solar panel requires a small but measurable amount of silver in its electrical components, and as solar installations scale globally, driven by both government policy and pure economics, the demand for silver in that sector alone is creating structural pressure on global supply. Some analysts estimate that solar energy demand for silver could double or triple over the course of this decade. Now combine that with EV expansion. Electric vehicles use silver in their charging components, their battery management systems, and their circuit boards. As car manufacturers continue the shift away from combustion engines, they are dragging silver demand along with them. This is not speculation. This is already in the production data. Here is the situation that becomes much bigger when you zoom out. Silver mine supply is not keeping up. Global silver mining has been relatively flat for years. New major silver discoveries are rare. Bringing a new mine into production takes years and enormous capital investment. So on one side of the ledger you have rapidly growing industrial demand from solar, EVs, and electronics. On the other side you have supply that cannot easily expand to meet it. That is a structural supply deficit. And structural deficits in commodities, when they persist long enough, tend to produce price moves that shock people. Now here is where gold enters the picture differently. Gold does not have the same industrial demand story. Gold's value proposition in 2026 is almost entirely monetary, and the monetary case for gold has rarely been stronger. Central banks around the world, particularly in countries across Asia, the Middle East, and the emerging market world, have been buying gold at a record pace. This is not new, but it has continued and in some periods accelerated. These are not retail investors buying gold coins. These are nation-states moving billions of dollars worth of gold reserves. Why are they doing this? Because the global reserve currency system is under stress. The US dollar has remained dominant, but its dominance is being quietly challenged. Countries that hold large dollar reserves have watched those reserves lose purchasing power through inflation. They have watched geopolitical events weaponize the dollar-based financial system, and their response has been to quietly accumulate gold, the one asset that no government can print, freeze, or confiscate remotely. This central bank buying has put a structural floor under gold. Even during periods when retail investors are not buying aggressively, central bank demand keeps absorbing supply and preventing major price collapses. It is one of the key reasons gold has maintained its strength even through periods of dollar strength and rising interest rates, conditions that historically would have pushed gold down. But that alone would be important. Something else happened. The interest rate environment is shifting. For the past 2 to 3 years, central banks, particularly the Federal Reserve, raised interest rates aggressively to fight inflation. High interest rates are traditionally bad for gold and silver because they make bonds and savings accounts more attractive. Why hold a metal that pays no interest when you can earn 5% in a money market account? That logic kept some investors on the sidelines. But now, inflation has moved in a complicated direction. Some categories of prices have cooled, others remain sticky, and the labor market, consumer spending, and credit conditions are all sending mixed signals. This uncertainty is actually one of the most powerful environments for precious metals, because it means investors do not have a clear, safe place to park money. When bonds are uncertain, when equities feel stretched, when real estate is illiquid, where does money go? It has historically gone to gold and silver. Here's the detail most analysts are not talking about. If the Fed begins a new rate-cutting cycle, and the data is increasingly pointing toward that possibility, the historical precedent is extremely clear. Gold and silver have rallied strongly in the 12 months following the beginning of a Fed rate-cutting cycle. The mechanism is straightforward. Falling rates reduce the opportunity cost of holding non-yielding assets like metals. More money flows in. Prices go up. Now let's talk about what is happening with the US dollar, because this is where the macro picture for 2026 gets genuinely complicated. The dollar is simultaneously doing two contradictory things. It remains the world's dominant reserve currency with no clear replacement in sight. But it is also facing long-term structural challenges from US government debt levels that are growing faster than the economy. Federal debt has surpassed levels that would have been considered alarming just a decade ago. Interest payments on that debt are now one of the largest line items in the federal budget, competing with defense, healthcare, and social programs. This is not a partisan political statement. It is a mathematical reality. When a government's debt load grows faster than its economic output for long enough, the only tools available are default, which almost never happens to major economies, inflation, which erodes the real value of debt, or currency debasement. All of these outcomes are historically bullish for gold and silver. This is where the story becomes much bigger than just two metals. What we are really talking about is the purchasing power of money itself. Over the last 100 years, every major currency in the world has lost the vast majority of its purchasing power against gold. A dollar today buys a tiny fraction of what it bought in 1920. Gold, by contrast, has maintained purchasing power across centuries. This is not a prediction about next month. It is one of the most consistent patterns in all of financial history. Silver, because of its dual nature, adds an additional layer. It benefits from both the monetary protection story and the industrial growth story. And when both of those forces align, as they appear to be doing in 2026, silver can move faster and further than gold in percentage terms. Now let's get specific about what the numbers and the market positioning are telling us right now. Professional traders and institutional investors track something called the Commitment of Traders Report, the COT report, published weekly by the Commodity Futures Trading Commission. This report shows how large commercial traders, hedge funds, and small speculators are positioned in the silver and gold futures market. And the positioning data has sent important signals ahead of major price moves in both metals historically. When commercial hedgers, the sophisticated players in the market who actually handle physical metal, reduce their short positions significantly, it often signals that they expect prices to rise. Conversely, when speculative positioning gets extremely one-sided in either direction, it can foreshadow a reversal. What the positioning data in 2026 has been showing is continued institutional interest in both metals. with silver in particular attracting attention from traders who understand the supply deficit story. Smart money has a way of moving before retail investors notice what is happening. Here is what happened next that almost nobody reported. The BRICS economic alliance, which includes Brazil, Russia, India, China, South Africa, and now several additional member countries, has been openly discussing alternatives to the dollar-based trading system. While a fully gold-backed BRICS currency remains speculative, the conversation itself has shifted. The fact that the world's largest emerging economies are publicly discussing how to reduce dollar dependence in international trade is a fundamental change in the geopolitical backdrop for gold. China, in particular, has been accumulating gold through both official channels and through mechanisms that are less visible in official reporting. India's gold imports remain enormous, driven by cultural demand and growing household wealth. When you combine government accumulation with private demand from the world's two most populous countries, you start to understand why the demand picture for gold is structurally different now than it was 10 or 20 years ago. And here is the connection most people do not make. As gold rises, driven by central bank buying, geopolitical demand, and monetary uncertainty, it tends to pull silver along with it. But silver, because its market is much smaller than gold's in dollar terms, tends to amplify those moves. A 10% move in gold can become a 20 or 30% move in silver. That is why silver is often called gold on steroids, a phrase that captures both the opportunity and the risk. Because silver does carry more risk. Let us be honest about that. Silver is more volatile. It drops harder during market panics. It has a larger industrial component that can suffer during economic downturns. If the global economy enters a serious recession in 2026, silver's industrial demand could soften and create downward pressure on price, even while gold holds relatively firm. This is not a reason to avoid silver. It is a reason to understand what you are buying. Let's talk about what this all means for you as an investor watching this right now. We want to hear from you in the comments. Do you currently hold gold, silver, or both? Drop your answer below. It helps us understand what kind of deep dive analysis is most useful for this community. The framework that makes sense for 2026, based on all the evidence we have laid out, looks something like this. Gold is the defensive play. It is the wealth preservation asset. It is the thing you hold because you do not fully trust what governments and central banks are going to do to the purchasing power of paper money. Gold has thousands of years of history as a store of value. It is nobody's liability. It cannot be diluted. Central banks are buying it, which means the biggest and most sophisticated institutions in the world are signaling something important. Silver is the asymmetric opportunity. It offers both the monetary protection of gold and the industrial growth story of a commodity that the green energy transition cannot function without. The supply deficit is real and structural. The gold to silver ratio suggests silver is historically undervalued relative to gold. And when the catalysts we described align, rate cuts, dollar pressure, industrial demand, and monetary uncertainty all firing at the same time, silver has historically produced returns that make gold look modest by comparison. The honest answer to which one makes bigger returns in 2026 is this. If gold makes 20%, silver could make 40 or 60. If gold makes 30%, silver could double. That is the historical pattern when the setup is in place. But if macro conditions deteriorate badly enough, silver could also give back gains faster than gold. That asymmetry is the entire trade. Here is the bigger revelation that ties all of this together. We are living through a period of genuine monetary uncertainty unlike anything most people alive today have experienced in their lifetimes. The post-World War II financial order, built around the US dollar, American economic dominance, and confidence in Western financial institutions, is not collapsing overnight. But it is slowly, unmistakably being questioned in ways it was not questioned a decade ago. That questioning is what makes this moment so important for precious metals. Gold and silver are not just commodities. They are not just inflation hedges. They are alternatives. They are the assets people reach for when they lose confidence in the system built around paper money and government promises. And right now, more people and more institutions are starting to reach for them than at any point in recent memory. The investors and countries positioning themselves now, before the broader public understands what is happening, are going to look very smart in a few years. That is not hype. That is what the historical pattern shows, every single time this kind of macro environment has developed. So the final question is not really silver versus gold. It is whether you understand what both of them are telling you about the moment we are in. We want to know what you think. Leave a comment below. Are you in silver, gold, or waiting to make your move? The conversation in the comments on this channel is one of the best in the precious metals community, and your perspective matters. If this analysis gave you a clearer picture of what is happening and why, Please share this video with someone who is trying to understand where to put their money in 2026. Most people are not getting this level of analysis anywhere else, and sharing it takes about 3 seconds. And if you are not already subscribed to Gold and Silver Intelligence, this is the moment to do it. We cover the data, the institutional moves, the geopolitical shifts, and the historical patterns that actually drive these markets, without the noise and without the hype. The precious metals market in 2026 is setting up for a move that very few people see coming. Now you are one of the ones who does.